In the world of Japanese candlestick charting, there is a recurring theme, the number 3. It represents a trend that has found its rhythm. But when you see 3 identical candles in a row, is it a sign to jump in, or a warning that you're already too late? Today, we are breaking down 2 of the most visually striking patterns in the market, the 3 red crows and the 3 green soldiers. We'll explore why the Japanese say bad news has wings, how to spot a rally that's running into an advanced block, and exactly where to find hidden support levels when the market pulls back. If you've ever felt like you're entering a trade right as the door is closing, this video is for you. Let's start with the dark side of the chart, the 3 red crows. Think of this pattern as an ominous group of crows perched in a dead tree. It's a bearish reversal pattern that signals a major shift in psychology. A standard upside gap 2 crows consists of 2 red candles, but the 3 red crows go further. This pattern features 3 consecutive declining red candles. But not just any red candles. There are specific rules for these winged messengers. They must appear at high price levels or after a mature, long-term advance. Each of the 3 lines should close at, or very near, their daily lows. This shows the bears are in total control until the final bell. Ideally, each candle should open within the real body of the previous day's candle. The Japanese have a saying, bad news has wings. This is why they are often called 3-winged crows. When this pattern appears, the market isn't just leaking, it's taking flight to the downside. Now, look at this specific chart. You'll notice the 2nd and 3rd red candles actually opened below the previous session's body. While the textbook version suggests opening within the prior body, these lower openings are actually more bearish. Why? Because it shows the market couldn't even manage a minor bounce at the open. The bears were so aggressive they gapped the price down, and the bulls were too weak to fill that gap. If the market opens low and fails to gain any ground all day, the bears aren't just winning. They've already won the war. Here is the honest truth about 3 red crows. They are often more useful for long-term traders than day traders. Why? Because by the time the 3rd red candle closes and confirms the pattern, the market has already dropped significantly. If you short at the bottom of the 3rd candle, your risk-to-reward ratio might be terrible. However, smart traders look for inklings of trouble on the 1st candle. Look at this example. The 1st crow actually opened at a new high. It looked like a breakout, but by the close, the bulls couldn't hold it. The price collapsed back into the previous range. When the market makes a new high and fails to sustain it, that's your flare in the sky. The next 2 crows simply confirm the funeral. Before we move to the bullish side, let's look at how to spot these reversals before they happen. Look at areas 1 and 2 on this chart. In area 1, the stock was making higher highs and higher closes. On a standard bar chart, it looked healthy. But look at the candlesticks. See those long upper shadows and small real bodies? Those are warning flares. They tell us that while the price is high, the buying energy is being dissipated. The bulls are pushing the ball up the hill, but it's rolling back down halfway every day. This exhaustion eventually led to a price retreat, which only ended when a bullish engulfing pattern appeared at point B. Then, look at area 2. History repeated itself. We saw higher highs, but we also saw a shooting star. A shooting star is a clear sign that the rally's strength is being drained. Shortly after, the 3 red crows appeared to finish the job. Now, let's flip the script. The opposite of the crows is the 3 advancing green soldiers. This is a sign of immense strength. Imagine a disciplined army marching forward. This pattern consists of 3 long green candles with consecutively higher closes. If you see this after a long downtrend or a period of stable prices, a base, it's a massive signal that the trend has shifted to the upside. The rules for soldiers. Each candle should open within or near the prior candle's real body. Each candle must close at or near its session high. The rise should be steady and gradual, not a single vertical spike. A word of caution. If the green candles are too long or extended, the market might become overbought. You don't want to buy the exhaustion at the end of the march. Look for steady, healthy growth. In this chart, we see a classic example. Each candle opened near its low and closed near its high. However, by the time the third soldier finished, the stock had already made a huge percentage move. For a short-term trader, buying here is risky, but for a long-term bull, it confirms that the floor is in. What happens when the soldiers get tired? We call this an advance block. In an advance block, you still see 3 green candles, but the second and third, or just the third, show signs of weakness. Watch for progressively smaller real bodies, long upper shadows. This means the rally is hitting a wall of resistance. If you are long, holding the stock, an advance block is your signal to protect your profits or tighten your stop losses. This isn't necessarily a signal to go short, but it's a clear sign that the easy money has been made. Similar to the advance block is the stalled pattern, also known as the deliberation pattern. This happens when you have 2 strong, long green candles followed by a small, weak green candle. This third candle might gap away, becoming a star, or it might be riding on the shoulder of the second candle. The Japanese call it deliberation because the market is literally stopping to think. The bull's power is exhausted. Again, this isn't always a top reversal, but it tells you the engine of the rally just ran out of gas. Don't be the one buying the top of a stalled pattern. Here is a professional tip that most beginners miss: the soldier support rule. Because the 3 green soldiers represent such a strong shift in sentiment, the starting point of that move becomes a psychological floor. I have found that on a market correction, the first or second green candle of the 3 soldiers often acts as a major support level. Look at this chart. After the 3 soldiers, the market hesitated and formed a doji and a harami cross. The price began to pull back. But where did it stop? It pulled back exactly to the level of the first green soldier. We see this again in this second chart. The market formed a base, marched up with 3 soldiers, and then corrected. It found support right at the body of the first soldier before heading higher. The lesson: don't chase the third soldier. Wait for the correction back to the first or second soldier. Look for a confirmation candle like a hammer, and that is your high probability entry. To wrap things up, let's summarize what we've learned today. 3 red crows are a bearish omen. Look for them at the end of a long uptrend. If they open below the previous body, the bears are even more aggressive. Watch the shadows. Even if the price is going up, long upper shadows, like shooting stars, tell you the bulls are losing their grip. 3 green soldiers signify a strong bullish breakout. But watch out for the advance block. If the bodies get smaller or shadows get longer, the rally is hitting a ceiling. Use corrections to your advantage. The first candle of a 3-soldier pattern is a line in the sand. Use it as a target for support when the market takes a breather. Trading isn't about predicting the future. It's about reading the footprints left by the big players. The crows and the soldiers are some of the clearest footprints you will ever find.